Good afternoon. Welcome to the Business Forecast. Today, I'm delighted that I am joined by the lovely Richard Feakins. Hi, Richard. How are you?
Hi, Nikki. Good. Rather warm, but good.
Where Richard is, it's rather hot today and his air conditioner's not working. So he's not in a sauna, he is in his office. Yeah, so today we are 1 week into our Labour government in the UK. So we are discussing either known or potential changes to tax, so that you can consider if there are any proactive measures that you should be considering or would like to make. This is not a party political on any side, it's just sensible, proactive tax advice that we need to do for clients. So whether you're happy to pay loads of tax, that's absolutely fine. But if you don't, we're trying to make sure that you know your options. Okay, so we've selected, there is obviously loads of different taxes we could talk about. We could talk all afternoon, but we've decided to focus on 5 particular areas. However, please do, you're welcome to post any questions as we go along, if you're watching live, and we will come back to you and try. Well, we will in the session. We've got time to answer the questions, but we have selected 5 subjects. Spoiler alert: we're going to talk about pensions, but that's going to be at the end. So stay tuned right to the end to watch the pensions information. Okay, so we are starting with property lets. What's going on there? What's the potential changes? What's happening?
Well, I think the first thing to do is just set the scene a little bit. So far, we have very few concrete proposals or details, if you like, around taxes generally. There are some things we do know, and there's a lot of speculation. Around furnished holiday lets, we do know that the regime is going to stop from April 25. It will disappear. And what this means is, broadly, you'll no longer be able to offset all of your mortgage interest against your furnished holiday let profits. You'll no longer be able to claim capital allowances on your furnished holiday let property, and the potential for business asset disposal relief on furnished holiday let business will be removed entirely. So what that means for an FHL investor is potentially going from a 10% capital gains rate on disposal to, at current rates, 24% potentially. So if there is an opportunity to sell, if you feel that now is the right time, then perhaps now is the right time to look at disposing of those properties.
Absolutely. And of course, this was something that was announced by the Conservative government, just to be clear. We don't know all of what's going to be happening either from an accounting perspective and the tax perspective either. We're still waiting. So it's very difficult because we are being asked questions already by clients, but we don't know yet on everything.
Yeah. So, for example, Nikki, you asked me a question earlier around brought forward losses on a furnished holiday let. Would they be able to be utilised in the following year? We don't know. We don't have that detail at the moment. The legislation's not there. Just moving on from furnished holiday lets to normal lets. Some of the comment here is not just about tax. So, for example, we have a reasonable expectation that there will be some form of rent control or rent cap put in place. Although it's not a tax issue, it's certainly a business issue. I would advise anybody with rental properties to review the rents on their portfolio and make sure they are at full market rent, just in anticipation of some form of rent control or rental cap coming in.
So make sure, presumably, that they have that in writing.
Yeah. We've also got the issue that almost certainly no fault evictions are going to be scrapped.
Oh, okay.
Um,
So we'll sort of go back to the sort of rules that were at the beginning of the pandemic regarding evictions then.
Yeah.
Okay.
So I can see a much greater use of, for example, debt collection agencies for rent arrears.
Yeah.
At the earliest possible opportunity. So as a property investor, I don't think we can afford anymore to let rents go into any sort of long-term arrears.
Yeah. Okay.
Then finally, I suppose, we're looking at potentially capital gains tax on the sale of let property. This is speculation, but it's been widely trailed. Will capital gains tax rates be in some way aligned with income tax rates going forward, or will they be incrementally increased until they do align? We don't know, but I think there's reasonable expectation that something will happen on capital gains tax. So again, now might be a good time to start thinking about divesting part of the portfolio.
So that's capital gains tax in relation to residential properties. Presumably that would be reflected in commercial properties as well.
Yes, yeah.
And then capital gains tax for non-properties, for say businesses, shares. If you're going to sell your business, what is there any sense of what's going to happen there?
Well, certainly business asset disposal relief. So this is the 10% rate you get on a lifetime allowance of £1 million worth of gains if you sell your own business.
Mm-hmm.
That is going to be reviewed and quite possibly removed.
So if you want to make sure you get your 10%, and that you would expect that not, if there is a change, that wouldn't kick in until April 25. Would that be right?
April 25, but I think we have to bear in mind that when these things do happen, that especially capital gains tax, you could expect it to kick in immediately from the budget.
Okay, so March budget rather than the November statement.
It could be November statement.
Oh my goodness! So you really need to get if you're going through a sale at the moment, get that completion finished.
Yeah.
Get your SPA signed.
I mean, to put capital gains tax rates in context, our current rates in the UK are at historic lows. I mean, I'm old enough to remember when Nigel Lawson introduced the income tax alignment for capital gains tax, and he was a Conservative chancellor. So it's not a stretch to imagine the same thing happening.
Yeah, hopefully some of the business bodies like FSB and that are lobbying for, for the smaller business owners, because, often that is their pension. They've not, probably put money into pension.
So I guess the question is, what can you do about it? One option, if funds allow, is to, if you're not in a position to sell your business, perhaps you might want to crystallize the gain, pay the 10% rate by perhaps inserting a holding company above your own company, acquiring.
Okay, that's a good point. Good point. But of course, you do need to make sure you've got the 10% tax to pay. You need that cash.
Yeah. And I think you'd have to have a reasonable expectation that the eventual rate was going to be A, higher than 10%, which I think is a good bet, and B, that at some point you're either going to sell your business or liquidate to using capital gains tax rules.
Okay. And sort of in the same vein, because sort of same sort of area, we just wanted to make a brief mention on carried interest.
So again, no concrete legislation here yet. It's still way too early. I mean, carried interest is currently charged at the higher capital gains tax rate, the same as let property, investment property. The proposals broadly are to align that rate with income tax rates. Indications are that Labour see it as a performance-based reward rather than a capital gain. The extent to which they're aligned, we don't know. Will they go as far as just aligning with income tax rates at the top 45% rate? Or will they go a step further and say, actually, this is employment reward and we want national insurance contributions as well on top? We don't know.
No, we don't know.
Certainly there will be a change.
And it's very carried interest as well. So if you do have any carried interest from any vehicle, do make sure you get personal advice for it as well, because there are still some instances that it can be taxed differently as well anyway. So do always make sure you get advice on each situation. Okay, so an area that hits the front pages a lot, school fees. So we were going to mention a bit about VAT and also sort of in general for school fees as well. So what's your current thoughts?
Well, we all know that there is going to be VAT.
Thank goodness for your children are too old.
Yes, mine have long flown the nest. Well, I mean, we know there is going to be 20% VAT on private school fees. That is a given, of course. When that will come in and the mechanism and any perhaps anti-avoidance that goes with it, we don't know yet. I know a lot of parents are rushing to perhaps make advance payments on school fees to try and avoid the 20% VAT. Just a note of caution on that. It may be the case that HMRC will view those as deposits rather than advance payments for the services. If they're successful in that, then that advance payment will be ineffective. Advance payments can be useful though anyway, because quite often a school will discount to get an advance payment.
Yeah.
So it might not be a bad idea in any case. Just a general.
They not only discount, but you're getting a discount, but you're also preserving to make sure that you're not getting the increases from the future as well.
That's right. That's right.
Double.
Yeah, absolutely. Just a general note on funding for school fees. It's probably outside the scope of this broadcast, but there are no private school tax wheezes that we are aware of that work. However, there are some sensible mechanisms, sensible ways in which you can do it, including, for example, offshore bonds and family investment companies, which are both very tax efficient. Essentially, in both cases, what you're doing is extracting income at the child's income tax rate rather than your own 45% rate. So if you'd like to discuss any of those, we're free to talk about those.
Absolutely. So last but not least, but is an area that there's lots of stuff to talk about, is pensions.
Yeah, so you probably recall that the Conservatives removed the lifetime cap on pensions, broadly due to the fact that a number of very senior doctors were getting taxed very, very heavily because they were going over their pot allowance. Labour have confirmed that that's going to be just too difficult to reverse, which is probably quite sensible. Keir Starmer did make a very strange comment in one of the televised interviews, debates, where he talked about removing the 25% tax-free lump sum on retirement.
The 25%.
The 25% tax-free allowance. They seem to have backtracked a little bit on that, but it seemed a very strange thing to say. So I think we have to have one eye on the fact that that 25% might, at some point in the near future, be removed as a concession, which obviously has a significant impact for very many people. It might, if you're considering drawing your pension anyway, perhaps sooner rather than later, in case this does change. I wouldn't rush into anything with a pension. Take good financial advice.
Yes. And also how much you're putting in as well. Again.
Yeah. So for quite some time, Labour have campaigned for changes to tax relief on pension contributions for higher earners. Rachel Reeves in particular suggested a while ago that perhaps there should be a flat rate of 33% relief for all pension contributions. Given the current state of the finances, I think that would probably be too expensive. And they might look instead to reduce the pension relief rate for higher earners down to the basic rate. So instead of 45% down to 20. Again, nothing concrete. They are consulting, but I would not be surprised to see I wouldn't be at all surprised if something didn't come in April.
Indeed.
And then finally on pensions, again, they have confirmed that they're looking at the pensions regime. And one area they are looking at is the inheritance tax relief for inherited pensions. So again, it wouldn't be a surprise if that exemption for inherited private pensions is removed. For a lot of wealthier individuals, they see their pensions as a way of passing down wealth through the generations, rather than as a pension pot as such, because it does come with that inheritance tax exemption at the moment. That will quite possibly change.
Yeah, so definitely if you're coming up to pension age, or if you're intending to put a lot into your pension, definitely get some good advice on that sooner rather than later, so that you don't. It would be awful if you were attending. I mean, I've got, actually thinking about it, I have got a couple of clients that are about to put in some very big pension contributions by using their previous year's allowances as well. They really need to crack on with that before they lose that opportunity.
Yeah,
potentially, because we don't know that they'll lose it.
Yeah, I think that's a really good point, but also in conjunction with potentially then looking at drawing the pension. Historically, whenever changes have been made to the pensions regime, the changes have only impacted what we call uncrystallized pension pots. So they haven't attacked those which are already being drawn on. So it might be the case that if you are in a certain position, you might perhaps consider A, drawing down the 25% tax-free, and B, just drawing a very small amount out of the pension just to crystallize the pension benefit. You don't have to take everything. I mean, many pension schemes are flexible, but in that way, you would protect the pension pot from any tax changes, hopefully.
Indeed. Okay. We haven't, surprisingly, we normally get lots of questions, especially on tax. So we do have a few minutes left. So if you do have a burning question regarding any of the areas that we've already discussed today, or another area, you know, Mitch is here, test him out, test his knowledge. So I promise I haven't planted any difficult questions anywhere. So yeah, if you are if not, that not a problem. We're always available. If you've come via LinkedIn, you've got our LinkedIn details, but you can contact us at Goringe Accountants. We'll come back to you very quickly, whether you're a new client or potential client. Very, very happy to help. But I don't think either we've just covered every possible potential question already, or we've gone to sleep, which is, you know, always another option when you're talking about tax.
I suppose I could talk a little bit more about capital gains planning generally.
And also, actually, two areas that I had on I was on a political podcast yesterday. Is there likely to be anything happening with loan charges and IR35 as well with the new government? Those are two areas as well, which it probably won't be, but that's what lots of people want to campaign on.
No, look, IR35 was introduced by a Labour government.
So it's only going to get worse.
They will not change it, remove it.
Yeah. To be honest, I could just see it being tightened up further.
Yes, yeah, absolutely. But saying that, the way that the tax regime has shifted over the past few years, the differential between a company director within IR35 and an employee is nothing, is minimal. The differences are between a self-employed person, so a sole trader, and an employed person. There can be quite a big differential there. So I certainly wouldn't see any reduction in national insurance contributions. I could see a reversal of the Conservative plans altogether and an increase in self-employed national insurance contributions to align with employee national insurance contributions, for example.
Makes sense.
And I don't actually understand a rationale between the differential in any case. I don't think many people do understand why there should be a difference between self-employed and employed NI. It is a little bit nonsensical in my view.
Indeed.
So IR35, I think IR35 probably already works very well where you're talking about self-employed sole traders being engaged by a company, because the onus is already on the company to ensure that they are correctly identified. The legislation is there. Where IR35 hasn't historically worked very well is where you have an engager and then what we call a PSC or a company. But all of these things are now being cleaned up, and the newer legislation will prevent a lot of these court cases going through. So all the high-profile news readers and media personalities.
No, Jeremy Vine's the one in the press this week, in all the accounting press anyway.
But these are incredibly old cases now.
Oh, they're so protracted. That's the thing as well. It's like almost like HMRC wants to wear you down, you know, because do you really want to be arguing about this for the best part of a decade?
You did mention changes to the loan charge.
I presume most people have already been caught already. They've already paid, surely.
There are still a lot of people who are in limbo.
Okay.
There are tens and tens of thousands of people who still haven't settled.
Oh my goodness, that must be stressful.
Who are still holding out for some, I have to say, miraculous result. I don't think we can expect anything other than that they will eventually have to pay.
Yeah, I mean, I think the thing is with that is, if there were huge reserves at the moment, it might be a different scenario. But at the moment, when there's a huge requirement for public funding and not a lot of reserves, it'd be hard to justify doing at the moment. However, if there had been lots of reserves, so you never know, it could be something perhaps in the future, because, you know, obviously there is a lot of pressure, and especially as, you know, there's a lot of nurses and things that got caught in it as well.
Nurses, doctors.
Yeah, and you know, that were missold these schemes. You know, and there's already been a whole range of suicides already. Unless there ends up being some loan charge documentary like there was the post office, and so it really makes something happen. But unless that has happened, yeah, you might just need to. Well, no, I can't advise whether you settle or not. That's got to be between you and your advisors. But, you know, some people can be, you know, understand why you want to just get on with your life. But some of the amounts are so high, you know, that's why, you know, people having to consider bankruptcy or solvency things. So yeah, it's very sad. Wait, is there something positive we can finish on?
So let's have a look. What can we do for capital gains tax planning? What can we do for capital gains tax planning? Okay, let's assume capital gains tax rates are going up. Capital gains tax rates are going up. So what can we do about it? We can bed and ISA.
Yes.
Sell shares underneath the 3,000 annual capital gains allowance. Pop them into your ISA, protect them from future capital gains. You've got two ISA allowances, 20,000 for a husband and wife, potentially. So there's a bit of scope there to cover at least some capital gains. If you've got a business, look at rebasing by selling your business to a holding company. Or if it's just time to wind it up and extract all of that cash that's in it, a solvent liquidation at a 10% capital gains tax rate is perfectly legitimate. Time to get on with that, probably, if it's the right time. We're pretty certain that 10% rate will disappear.
What about rollover and holdover release and all that malarkey?
Well, yes. I mean, you can gift business property generally to somebody else and hold over the gain. But of course, you're just holding over the gain into a new capital gains tax rate when they eventually dispose of it. So
not
I
great.
don't know how helpful that would be.
Of course, there's the employee ownership trusts, which don't have CGT.
Yes, yeah, yeah.
Something to consider.
Employee ownership trusts are very, very useful for a business owner looking to retire or perhaps step back a little bit from the business. Transfer of the majority of their shares, so anything over 50%, to an employee ownership trust, a special vehicle, is free of capital gains tax and inheritance tax. And when I say transfer, I mean a sale. So potentially they could extract cash value out of that sale to the trust. And of course, it's good for employees.
Yes.
The trust can pay out small tax-free amounts to employees each year. And you have employee engagement in the business.
Yeah.
And on the positive side, the owner director can still potentially control the business.
Okay. Yeah, but obviously get detailed advice on that, because you need to go through a lot of things before deciding whether that potential structure is relevant for you and would work.
Yes, we've made that sound very simple.
Oh yeah, it's just so simple. Let's just do an employee ownership trust. Let's do that tomorrow. Thank you so much, Richard. Really, really helpful.
It's a pleasure.
Nice, great, huge amounts of information we've fitted into that 30 minutes. Thank you so much. Please, anyone that's got further questions that didn't want to ask live, do feel free to contact Richard or myself directly via LinkedIn or Goringe Accountants, and we'll be delighted to help you. Otherwise, have a lovely weekend. For those watching football this weekend, good luck. And at the moment, it is a working day on Monday. It hasn't been declared a bank holiday as yet.
Again, another no commitment from our new government.
Anyway, cheerio. Thank you very much, everybody. See you next time.
Have a good weekend.